Okay, it is showtime. Good morning, everyone. Thank you for joining us today. We are here to discuss in more detail the major milestones for hot chili that have been recently announced. The company has published two pre-feasibility studies, the first for its large-scale copper gold project Costa Fuego, and the second for Huasco Water, the strategic water asset controlled by hot chili. Management will give a brief presentation, and then we will open up the call for questions. Before we start today's presentation, it is important to remind everyone that some of the statements on this webinar may be forward-looking statements. Forward-looking statements may include, but are not necessarily limited to, financial projections or other statements of the company's plans, objectives, expectations, or intentions. These matters involve certain risks and uncertainties. The company's actual results may differ significantly from those projected or suggested in any forward-looking statements due to a variety of factors, which are discussed in detail in our regulatory filings. I will now pass the webinar over to the Hot Chili management team led by Christian Easterday. Please go ahead, Christian.
Thank you very much, Graham. Christian, I'm the CEO and Managing Director of Hot Chili. I also have to my left Ryan Finkelstein, who's our Chief Financial Officer, and to my right, our Chief Operating Officer, Grant King. So as Graham explained, the company has achieved some major milestones over the last few days. Last week, at the end of last week, of course, reporting on the long-awaited pre-feasibility study for our combined production hub called Costa Fuego, located on the Chilean coastline north of Santiago. Importantly, located as one of the lowest elevation large developers outside of a major. So as you can see on the map, location is everything. We're down on the coastline at 740 meters elevation with the Pan American Highway running through our project and 50 kilometers from port. And this very advantageous location has again been able to bake in very low risk, low operating and low capital costs for a project of this scale. As this slide also outlines, the project is extremely well advanced. So not only is it meaningful, it's also near term. And it is this advantage that really shines through in the numbers and has the project on track for first production towards the end of the decade. So if we're moving forward into some of the key outcomes from the pre-feasibility, we have produced a very robust project definition that is supporting a very high metal output. This is one of only 5 projects that is in this class outside of a major miner in the world. We have a peak production period over 14 years on a 20-year mine life now established, and that peak production is hitting around 116,000 tonnes per annum of copper equivalent. That's based on 95,000 tonnes of fine copper production and almost 50,000 ounces of gold. Look, the pre-feasibility has hit some key targets for us: short payback, a decreasing strip ratio, and a very, very stable low operating cost of around $1.38 per pound on our C1 cash cost. We've had increases in our net present value after tax. We've had a very, very strong outcome on maintaining a low capital intensity for this project. And in addition to that, we've been able to afford significant de-risking in the project on key areas such as our tail storage facility and block cave as we move into the bankable study. On the next slide, we just have a comparative between the 2024 PEA, which was run at $3.85 per pound long-term copper price, $17.50 per ounce gold, to the pre-feasibility, which has just been announced. And that pre-feasibility is being run now at long-term consensus prices 21 months later of $4.30 per pound copper and $22.80 per ounce gold. So after a significant amount of investment in this pre-feasibility, we've now reduced the study confidence from an accuracy level of 50% in the preliminary economic assessment to now 25% in the pre-feasibility, which sets us up for a strong basis moving into the final definitive feasibility stage. So as we can see here from our key comparative markers, a lot of green, Post-tax NPV increases, a really sizable increase in our life of mine free cash flow, which is sitting just under $4 billion US over that 20-year mine life. Getting the project now to a 20-year mine life, and we'll talk about Verde shortly, and the pathway towards building a 30-year mine life on this project. But really pleasingly, we've continued to see continual reduction in that strip ratio on our open pits, now sitting at 1.5 to 1. On top of that, we've also had some reductions in our sustaining capital, as you can see there. But we have also, taken on increases in capital, both startup and expansion. And overall, our total cash costs have remained fairly in line with our PEA. And because of the increase in the long-term consensus copper price and gold price, and that maintenance of a low operating cost, what we've had margin build in the study, and that margin build has more than offset those increases in capital. Just looking at this, the startup capital going from 1.05 billion to 1.27 billion, we're still sitting with a ratio of around 1 between our net present value after tax and our startup capital. But we've seen a significant lift in our expansion capital, and our COO, Grant King, will discuss some of the almost $440 million US that we put into de-risking on that expansion phase, particularly around the cave and also the tails facility. So overall, a very robust and rock solid pre-feasibility effort from the team to be able to keep this pre-feasibility and the financial metrics in check on this large scale project that we're building out. Some of the key benchmarking, which provides, context for where Costa Fuego sits within the pipeline of development projects globally that are not controlled by majors. And this is really a list of benchmarking that Hot Chili does routinely. We understand our space very well, and this is one of the key benchmarking graphs which really differentiates the company. This is about a company's or a developer's leverage to copper price. One of the key attributes that Hot Chili really likes to talk about. So for every 10% lift in copper price, we see some 32% lift in the value or the post-tax NPV on this project. Or to put it another way, every 10 cents per pound lift in the copper price above $4.30, we see another 100 million US added to post-tax NPV. And so when we plot out that ratio of all of our peers from all of their publicly available development studies, and what we see is that Costa Fuego is one of the most exposed large-scale projects to copper price. And really that relationship between size and leverage, you can all see quite clearly on this benchmarking graph. On the next benchmarking graph, this is also one of the key attributes of the project. So not only have we produced one of the top quartile projects in the pipeline by production capacity, we've also produced one of the lowest capital intensity projects in the pipeline. And this is about elevation. So we can see here, cascading from left to right, the elevation of some of the peer developers in our space in South America that dominate the project pipeline in terms of meaningful new supply. And we see quite clearly laid out in dark blue pre-feasibility studies, in light blue PEA studies at that lower accuracy level. But we see that declining elevation being directly related to lower capital intensity. And that is really the challenge when you're not a major trying to develop one of these projects. You want a cheaper project to build that puts out a lot of copper and so has exposure to this coming thematic on a rising copper price environment. Moving on to our next slide, I'll pass over to Grant King, our Chief Operating Officer, to talk about some of the key de-risking that has been put into this pre-feasibility, how the project layout looks, and provide some comments around the overall split between sulfide and oxide production.
Yes, so I guess this is, as already mentioned by Christian, we've invested more money into de-risking our key risk items, but really the headline items here are the underground mine, the block cave, and the tailings storage facility. So part of the de-risking approach to the block cave was really to get in global caving experts to review what we're doing there, and to really take a view on the project that is very conservative. There's actual upside that we've left on the table here because we wanted to keep the cave at a conservative draw height. We've added a lot more detail to that design, and we've gone out to the market and gotten updated capital costs that have been applied into that build. We've also responded to the timing of the cave by increasing the time frame that we have to establish that cave, such that the development profile of getting down to depth at the cave is longer, and the time to actually ramp up the caving process has more time allowed for. The other option that we've looked at here for that cave is to look at an open pit only option, and we've completed a scoping study into that assessment to compare with our PFS design. If I move from the underground mine to the tailings storage facility, we've looked at our seepage control measures in the tailings storage facility and got those, really looked at what the geotechnical and seismic activity might do to that infrastructure, and built a design which caters for that. We already benefit from very dry climatic conditions being in the desert, but we've installed quite an extensive hydrogeological monitoring network. And furthermore, we've gone from just a one TSF that we're considering to look at other options within the region so that there are further locations being assessed. There are a host of other items that form what we've looked at as our risk reduction strategy. And that is, looking at the right-hand side of this slide, we've got the rope conveyor, where we have confirmed and adjusted that design so that it is more suited and more optimized for reducing costs. We've also done extensive weather monitoring along that path, in particular with wind speeds, because it is an elevated solution. Acid rock drainage, we've built proxies for our acid consumption and generation within the ore body and waste material, and those have been applied to the mine blocks to confirm that we have sufficient acid neutral material for construction of our major infrastructure, such as the TSF, but also the foundations for major plant. In respect to hydrology, we are naturally in a low permeability and low recharge area, but we've confirmed all of that. And as I said before, there's an extensive hydrology monitoring network that is across both deposits, including San Antonio as the third smaller. Closure planning is really well built out in this PFS, particularly compared to the PEA. We've defined our baselines. When you look at the picture of the topography, you can see straight away that there is not a large amount of vegetation to clear, and we're storing our topsoil for progressive closure as we mine out each deposit, starting with product ore. From a metal recovery, we have reviewed our moly recovery, and it has led to an improvement in our expectations of what can be achieved there. And we've also tested the conversion of moly from its presence inside our copper, gold, silver moly concentrate to create a standalone moly concentrate for sale, and that has demonstrated that recovery is good across all of the deposits of concern. And seawater use, this has been a long-term approach of ours to use seawater because of the benefits that we get in processing. We've redone and expanded the lock cycle testing program to confirm that it is the optimal processing method. In terms of how seawater applies to areas of the project that require fresh water, such as our underground mine and concentrate washing, we've got small-scale reverse osmosis plants built into the project to allow for that to occur. If we look at the next slide, we've got the project layout here, and those who are familiar with the PEA will probably notice that there's not a lot of change. Similar to Christian's discussion on the metrics comparing the PEA to the PFS in finance sector, we've got the very, very similar layout. There are slight tweaks. We've adjusted the rope conveyor route so that it is a lower cost option and reduces the elevation climb in the first leg. Cortadera. We've also made allowance for it to pass through Productora by adjusting the waste dump layout. But other than that, it really is a very, very similar carbon copy to what was put at the PEA. We've added the detail where it's required, creating new dump leach locations in Productora. But other than that, this is a very familiar layout to what we saw at the PEA. When you look at this layout, you're seeing a centralized processing facility to the west at Productora. That has a 20.7 million tonne per annum sulfide concentrator, and there is a heap leach facility coloured in green here just to the north of it that processes 4 million tonnes per annum oxide material. Other than that, I think we've covered everything, and you can probably see a little more detail on the San Antonio Haul Road in this layout now. But other than that, it's very much unchanged from the PEA.
Thank you, Grant. Well, moving out of the Costa Fuego pre-feasibility, great to have the project now defined at that circa 100,000 tonne production scale on copper and a 20-year life built. But what is even more pleasing for the company is the recent discovery of Verde, some 35 kilometres to the south of where we're intending central processing. So this is something that took the company over 6 years to get its hands on. It is now unified for the first time under one ownership, allowing access to the centre of this porphyry deposit, which was never able to be drilled previously. So prior to Christmas, we were able to put a very, very strong result out on our second drill hole on a drill program, which continues to this day and will continue, I imagine, for the rest of the year. So we have one drill rig in operation, drilling the lateral extents of a porphyry system that is putting out very strong numbers, 300-metre intersections at 0.5% copper, 0.3 gold from near surface. But what is really important to us are the wide, higher grade intersections being returned from this project, some 100 metres at 0.7 copper, 0.3 gold. And when you look at these grades and you realise that 0.1 grams per tonne gold will put dirt in a truck and send it to a central processing location to the north, then this is certainly something which is throwing up the potential for higher grade open pit tonnage to be supplemented into our mine plan. And given the scale of the system, if we move on to the next page, we can see a deposit footprint or a discovery footprint which has rapidly grown. When we first put these drill holes out, it was a couple of holes 400 metres to the north of a historical oxide pit that had been mined by a family and privately owned for over 50 years. Now we see some 16 holes or 15 holes that are due to be returned with assays, some 12 holes where 8 of the 12 holes all ended in mineralisation, all of them containing higher grade wide intersections, and an initial discovery zone of higher grade material, some 200 by 200 metres in dimension, that is now being joined by additional higher grade centres as the drilling migrates to the south. At the moment, we've drilled an area that is approximately 1 kilometre long by 550 metres. We're starting to see multiple high grade areas within this porphyry start to present. At the moment, we have not drilled a hole that has not been mineralised, and nearly all of those holes are mineralised to end of hole. So this is a discovery that is adding a significant amount of growth to the project, and certainly the company is planning to accelerate drilling on this project later in the year as we move from shallow RC towards diamond assessment of the higher grade areas. But certainly this is what is taking us on a pathway from 20 years in the pre-feasibility towards 30 years. We've initiated a second DIA, environmental baselines have commenced on this, and we are intending to integrate this as rapidly as we can into the definitive feasibility so that we can improve the economics, the mine life, the amount of metal that will be produced from this large-scale coastal production hub over the coming years. So I'll now pass over to Ryan Finkelstein, who will be discussing how we pay for all of this without diluting our shareholders into oblivion, I think is a term that's been used in the past. So junior company with a $1.27 billion project to build in about 2.5 years or 2 years' time when we'll be at the project financing table. So a lot of what Hot Chili is focusing on now is how we finance this and avoid dilution for our shareholders.
Yeah, thanks, Christian. So we're looking at a number of funding options, the first being the potential royalties on the Verde. So as Christian spoke to earlier, we see that as a key pillar of growth for the company. And as we grow this asset, we have the option for further royalties on the asset base. And we already have Cisco Gold Royalties as a significant investor with a 1.1% payable royalty across the metals on Costa Fuego. Additionally, we also have streaming options on the precious metals in our ore body available to us at Costa Fuego, and this was left out of the initial deal with Cisco Gold Royalties. And just to add on to that, we also have potential offtake agreements that we can consider. We have a strategic investment from Glencore who can purchase up to 60% concentrate for the first 8 years life of mine. And this has become a growing area of focus for the company, with 40% of our concentrate uncommitted, and particularly in light of the extremely tight concentrate market that has developed over the last 12 to 18 months. And lastly, we have Huasco Water, which we see as a bit of an enabler for us. We have an asset here that we believe can shield the equity side dilution on the copper project, and with the PFS that Christian will talk to in a bit, showing really strong fundamentals of $1 billion post-tax in PV. And we have a 80% interest in this asset that we can look to sell down as required.
No, thank you, Ryan. So yeah, I guess outside of all of the standard levers that multi-commodity, large-scale copper projects like this offer, offtake, streaming, royalties that allow companies to, I guess, navigate dilution a little bit more effectively. The real key differentiator on the next slide that we'll talk about is what we've just delivered this morning, which is the Huasco Water pre-feasibility. So this is really a 2-for-1, 2 assets now at pre-feasibility level. This opens the door for the company to consider its strategic partnership options and also to consider sponsorship options into this project while we navigate this final phase of investment and growth to position this project at its most optimal point when we come into financing in this around 2 to 2.5 year final stage of development. So Huasco Water, this is the first time numbers have been put out on this. It's been over 2 years since we've been focusing on this business development opportunity. It was born out of foresight by the company over 12 years ago to realise that water scarcity in the Atacama was only getting worse. And once we received our first metallurgy numbers that confirmed we had better copper recoveries using saltwater processing, we didn't hesitate in making an application for a maritime concession. Not something that is done lightly in Chile. The process was very unknown at the time. And now Hot Chili is one of only 2 companies in the past 18 years to have secured a maritime concession to extract seawater from the coast. Uniquely, over that time, now regulatory conditions in Chile have changed. There is significant restriction to extracting continental water for new mine development. Existing mines within Chile are all clamoring to build desalinated water plants because 75% of production from Chile uses desalinated water or fresh water to process. We're very lucky. We have a coastal project where most of the coastal projects do enjoy saltwater processing because of the metallurgy. And because of that, Huasco Water for us, having this license in place means that Hot Chili has access to industrial scale seawater supply of some 500 litres per second. The pre-feasibility that's just been put out in concert with an MOU that Hot Chili has just executed with our subsidiary Huasco Water has really anchored this potential large-scale regional water business. So we have around a 500 litre per second demand for 20 years. That has produced a post-tax NPV of around $120 million for a $150 million build, producing a 19% IRR. This is a very attractive business for the potential industrial water sector of the world to look at. But what is even more attractive is the regional opportunity that we have here. And that is what is outlined here in this table in stage 2. We looked at 1,300 litres per second of desalinated water supply, how much that would cost, around $1.4 billion, but producing another $1 billion approximately of post-tax NPV, also done at 8%, and to achieve a 19% return for the investor. What is really exciting about this is it doesn't stop there. This is a scalable business across a potential customer base of around 4,000 litres per second in the region. So when we looked at this license that we had, we also looked at whether anybody else in this region had a license. And what we found was that we are the only company holding a maritime concession in this entire area. We started this study and our independent consultants quickly confirmed to us that it is prohibitive for water solutions from the north or south to come in and supply the Huasco Valley region because of distance. 80% of operating costs is associated with transmission costs, which means that solutions from the north or the south are really restricted commercially at being able to supply water at a cost that means that some of these large mining developments around us can actually use that water financially. So when we look at the next slide, we look at stage 1 and what this seawater supply will look like. We're very close to the coast, as you can see, some 62-kilometre pipeline that will be built. We had 2 independent engineering groups study this so that we had optionality around the type of water network that we wanted to consider. Firstly, whether it was above ground, whether it was below ground, different pumping arrangements, and all of that means that a lot of the trade-off studies have been done to take this now also into definitive feasibility in parallel and tied in with Costa Fuego. So for Hot Chili, seawater supply to our project is absolutely critical. We see this project commencing at the end of the decade at the same timing as Hot Chili and delivering very short paybacks and a very strong return for potential water investors. But when we look at this area and you can see some of the big projects around us, this is a grouping of almost 20% of new supply in one location in the world, almost 1 million tonnes of fine copper production of a cluster of large scale, meaningful, undeveloped copper projects that are all sitting, luckily, in the higher Andes to us. So when we look at stage 2 and we look at the real opportunity here for the industrial water sector, we look at what the timing and what the potential customers that we've been in discussions with for quite some time now would look like. And in concert with that customer base and those discussions and the NDAs that are executed with those neighbouring large-scale producers, what we are doing cooperatively is looking at a solution to supply industrial scale water to the entire Huasco region, to the communities in which we operate, to the agricultural sector, and to these large undeveloped projects, which at the moment do not have a desalinated water supply solution. So given the 10-year timeframes that Hot Chili has just gone through to secure this maritime concession, and given the fact that regulatory processes for maritime applications in Chile have not changed since we were able to secure that permit, we now have a first mover advantage to potentially unlock a huge amount of undeveloped copper supply for the world through this multi-user water network, which we are studying in concert with these parties. So as we said, this is another $1 billion US of post-tax NPV, which goes straight to our bottom line. It's a strategic asset, which we are very much following in the footsteps of what most of the mining industry is doing in Chile. So outsourcing of water infrastructure to the industrial water sector is something that's going on in Chile. We see Antofagasta last year outsourcing its water, so taking $400 million of capital out of their expansion of Centinela and receiving a $600 million check from a consortium that is now going to finance and build that water infrastructure for Antofagasta at that large project. And so what this is the opportunity to follow suit for Hot Chili, to outsource $150 million of capital, as we've done with the Costa Fuego pre-feasibility you've just looked at, and to take on a higher operating cost for the supply of water that generates a 19% return. When we had our independent experts look at this highly attractive water investment environment in Chile because of the water scarcity issues in the Atacama, we looked at ranges of return for major water investors of around 12 to 19%. We chose the higher end to, again, be more conservative and make this attractive to also facilitate discussions with quite a number of parties which are under NDA with the company looking at this very scalable opportunity. We also completed, on the next slide, a conceptual study at how this large multi-user water network would migrate further into the Andes, providing solutions to all of those projects that are up on the border, up at around 4,200 meters elevation and higher. So this is something where we've studied a 1,300 litre per second stage 2 or first stage of our desalination. We've identified the next step, which would be a further 1,000 litres per second of desalinated water supply. And as you can see there, that catchment is significantly larger than what we're looking at. So this is a business that is scalable, that is being run at the same time as our Costa Fuego copper project, and is being run to benefit our shareholders by providing a potential monetisation option that can shield our shareholders from dilution in the large funding that will be required on the equity side to build Costa Fuego. We're looking at our 80% interest in Huasco Water to potentially be sold down over the coming couple of years as we move towards project financing. We're engaged with 10 of the largest water consortiums and water investment groups in the world with NDAs, and we're engaging with all of the potential off-takers. At the moment, stage 1 is secured by an MOU to negotiate an off-take agreement between Hot Chili and our subsidiary. And stage 2, which is the desalination, we've already secured 165 litres a second of desalinated clients with MOUs executed. And the timing of stage 2 is very much about the timing of the required desalination water requirement for CMP's Los Colorados mine that you can see there at the top of the page, some 2 years timed after the commencement of production for Costa Fuego. And that project will be requiring 200 litres per second. So already making very big inroads into the MOUs, which are the forerunners for offtake agreements, and very much that commercial process represents a large business development opportunity for the company. The more MOUs that are executed and are converted into offtake agreements, the higher the valuation of this potential large-scale water business is. So at the moment, this has been very, very, pleasing to the company to finally provide the numbers, what the cost of water has been determined to be, what the price that Hot Chili and other clients would be expected to pay to attract tier 1 water major into this area. But we are in Chile, where most of the world's largest water consortiums are in Chile, building these desalination plants to unlock further copper supply in the Atacama region and to develop this in concert with communities, with government, so that Hot Chili is not just differentiated by the fact that we have a strategic asset that none of our peers have and can just speak about in terms of how you fund a copper project, but really importantly, this is a differentiator for our social license to operate. They're not just a company that is coming to the Huasco region and promising 2,000 jobs during our construction phase and 800 standing jobs over the life of mine on this project, and all of the benefit that we brought into the community and the 10 years of work that we've done with the local communities and stakeholders that we operate with. But this is about now supplying water into the desert as part of our commitment. And this is not water that is going to be for free. This is about enabling the government and working with the mayors of those major townships to now start to study the distribution points, which can bring a lot of benefit to the community and the agricultural sector in this valley. So hopefully that provides a great snapshot as to two key catalysts and what that has really done for the company. We've done that at record copper prices, where our copper project instantly put another $1 billion of net present value after tax at the current spot price that we announced the pre-feasibility on. We've showcased a business development opportunity which before today had no numbers on it, and that has really created a very strong value platform for us to now commence our potential partnering process with quite a number of groups across our copper project and across our water project. And that process will certainly now start to gather speed now that we have these assets at pre-feasibility level and we're able to contemplate transactions against the asset rather than the market capitalization in this very depressed equity market that we find ourselves in. So thank you very much, and now I'll pass back to Graham for any further questions.
Thank you, Christian. There are several questions. There are several questions on Huasco Water, so I'm going to do my best to consolidate, and we'll start with Huasco Water. So there's 3 or 4 asking about timelines to transaction or monetization, but I'll layer that in with this question here. Antofagasta completed the sale of its water assets for the Centinela mine expansion in June 2024. How are our water assets different than that of Antofagasta, and how do you plan to proceed in the sale process, learning from that transaction?
Sure, thank you, Graham. Well, it's not really a one-to-one with Antofagasta. They had an existing pipeline that moves water, seawater actually. So there are a lot of similarities. Centinela is a large seawater processing project that is going a major expansion to take it from around 200 to 300,000 tons per annum of fine copper production. So it's one of the stellar assets of Antofagasta's portfolio. They had water infrastructure there that was approaching the end of its life, probably 4 to 5 years life left on that 132 kilometre water pipeline to 2,800 metres elevation. And so what they were looking at was building a parallel pipeline and pumping station to supply seawater. So in that respect, it's very similar to Hot Chili, except it's 3 times the elevation and it's about twice the distance. It was estimated at around $400 million to build. Ours was estimated at $150 million to build, both above ground solutions. Add another $50 million onto that if you want to put it under the ground for Costa Fuego. So comparable capital and comparable scale. However, it was supplying about twice the amount of seawater that Costa Fuego will be requiring. It was around 1,100 litres per second, whereas our water infrastructure is going to require around 500 litres per second. So you can roughly say that it's almost double what Costa Fuego's seawater supply pipeline will look like, both from a cost perspective, from a supply perspective, and no doubt the $600 million that they were able to entertain on that is probably around twice the check size. So when you do all of those discounts, you get to a difference in our NPV and our startup capital. But, you know, what we have on top of that is a very, very large regional desalination water supply opportunity of some 4,000 litres per second. That's unique. that is the same scale as water supply to Escondida. And if you're tracking what BHP and the partners there at Escondida are doing, that water supply infrastructure, as it's scaled up to 4,000 litres per second, it's cost a lot of money, but it's also saved a huge amount on operating costs for BHP. So we don't just have outsourcing of infrastructure going on with Antofagasta. One of our peers, Los Andes, signed a letter of intent to a water license that doesn't exist, to an easement corridor that doesn't exist, so that they were able to talk with a consortium that might be interested in building them a water solution following a very long process to secure those licenses. That has attracted one of the largest industrial players in Colbún that has moved out of the industrial sector into water and has made a significant investment into that to underpin the investment and the process now to secure Los Andes with their Vizcachitas project in the south, their water solution. And then we even turn back to BHP, and not a lot of people know that BHP's Spence mine actually outsources around 1,300 litres per second of desalinated water supply. So even BHP outsources their water. This is a growing trend in Chile. And as I mentioned, over the last 10 years, things have dramatically changed in the Atacama. This is probably one of the hottest jurisdictions for water investment in the world. 12 to 19% returns on investment are at the high end of global water industry. And this is an industry that is not that much smaller than the global mining sector. So we've had a significant amount of interest from some of the biggest names, some of them mentioned even in some of the discussions that we've been having. But importantly, we see a lot of interest in this project. It's an annuity opportunity, and we see that this is a growing trend by mining projects in Chile to reduce their capital hurdle and to outsource that water supply and to be able to monetize that. Your answer to your question is to when are we going to monetize that? I'd love to announce that tomorrow, but unfortunately those discussions are in the early stages, and we'll be advancing those throughout the rest of this year, Graham.
Perfect, thank you. And then one more on Huasco. Can you elaborate what portion of the CapEx from the recent PFS is related to the water infrastructure? And if and when a sale, we just touched on that when the water rate materializes, how much estimated reduction in the CapEx one can anticipate in an ideal situation?
Sure. Look, Graham, just to be clear, if it wasn't clear, the water infrastructure has been taken out and put in Huasco Water. Huasco Water owns all of those assets now. We've moved all of those into the subsidiary. So Costa Fuego's pre-feasibility and Huasco Water's pre-feasibility were done in concert. We wanted to employ competitive optionality on the engineering studies that were independently completed on Huasco Water, take advantage of all the engineering that was going on Costa Fuego. So we actually had two independent engineering groups, ILF and Wood, that undertook the study. So the water infrastructure capital has already been removed from the Costa Fuego pre-feasibility, and the water infrastructure capital is now sitting in Huasco Water, $150 million US to build that seawater stage 1 solution.
Perfect, thank you. Moving on, there's a few more here. Does Hot Chili remain committed to its North American listing?
Yes, of course. We have spent 3 years building relationships in North America. What has come out of that is already a great endorsement with the investment by Cisco Gold Royalties into the project, and remembering that this was a royalty that had several unique terms added to it. Firstly, there is no effective date of production that the company is marching to. We don't receive scaled up royalties or penalty payments to be made if we're not in production in 2029 or 2030. And more importantly, we have buyback rights to buy back 50% of the royalty going out 4 years if there is any change of control on the company. And so to materially reduce that 1.1% royalty, which was just isolated to Costa Fuego. So we were, I guess, very careful with that royalty agreement to ensure that all of the last remaining consolidation efforts that we were engaged in, we're not getting a royalty put onto them. And that has now left that optionality on royalties still across this fantastic new discovery in the south of Verde. So that is one of the key things that is one of the items that's come out of that North American listing on relationship building. We're also working with some of the largest investment banks in Canada and hoping to see expanded research coverage in our universe. And most importantly, as we progress towards this final investment decision, project financing, as we've seen globally, the large-scale copper sector has primarily been financed out of the North American markets. It's the reason why we are in North America, not least of all because our project is in South America, and nearly all of the large-scale copper developers in the world are listed on the North American market. We are a very big fish in a little pond in Australia, and we are wanting to make sure that Hot Chili has all of its funding optionality and funding pools available to us over this next 2-year final stage of our journey.
Perfect, thank you. There are several questions on Verde, mainly around what is the plan and how aggressive does the company plan to be on drilling out Verde? And there's one follow-on question, based on the early indications, what type of resource size are we looking at Verde?
A few questions I have to be careful on. Look, Verde is very exciting for us. We wanted to make sure that the discovery was real and not a one-hit wonder. It's why we waited several months to put another 12 holes out into the market, really locked down on that initial 400 metre by 550 metre discovery zone. We've now provided an update. That footprint has more than doubled, and we're liking what we're seeing. What we're really focused on at Verde is on the areas that have higher grade. This area is 35 kilometres to the south. It's going to require a bit of that gold credit to cover trucking, but we are really looking to displace higher grade material into the front end of our mine plan and focusing specifically on open pits. So that'll give you a reason as to why we're going nice and gently with one RC drill rig drilling single shift, not least of all because we are managing our cash carefully. We reported just over $19 million at the end of the year. So with one drill rig, our burn rate is being managed well. And we wanted to ensure that we could deliver these pre-feasibilities into the market and opening up those funding discussions against the asset level. So until we are well progressed with that, we'll be very careful with what we're thinking on funding, and therefore we are not looking to accelerate that drilling at any point in the near future. Once we've progressed through further on some of those strategic discussions, we'll take a view on exactly how fast and when all of the diamond drill rigs will turn up. And no doubt, given that most of our holes are finishing in mineralisation and multiple holes are finished in high-grade mineralisation, I imagine that we're probably going to see drilling being undertaken across this property for the next coming year. Certainly an opportunity to be drilling this out the entire way while we're completing the definitive feasibility. So providing a very nice bridge across the last of the Lassonde Gap, which our commercial team has been working hard on to get these last elements of consolidation. What I will say about Verde, which is quite exciting for us, this was not our number one target in the area. This was our number 2 target. So we're not done with consolidation. We always saw that this hub had the potential to grow towards a 2 billion tonne hub and marry again very well with multiple 2 billion tonne hubs that sit around us, being the Filo and Jose Maria hub, the Nueva Union hub of Teck and Newmont, and now what looks to be a 2 billion tonne hub emerging with Atex and Antofagasta next door. So this is just the coastal version. This is a cluster of deposits that, luckily for us, are all very close together and can employ central processing. So my answer on the drilling is we won't be accelerating just yet. But when we do, I imagine that will be triggered by Hot Chili being in a much more comfortable position with its discussions with strategic potential partners.
Perfect. Thank you. Next question, is there a scenario where the block cave is replaced with a larger pit? If so, what does that, what is that event, and what does that do for production, CapEx, OpEx, etc.?
I'll probably pass over to Grant to discuss this as he was overseeing a lot of the conceptual study. But from my perspective, it's a positive scoping study, and therefore it warrants more work. I think that we very much appreciate that it is a level of technical risk, as you've seen. We've just added a significant amount of capital and additional development timeline into that to de-risk it. So we recognise the risk, but it is at the back end of our project, and it follows a significant higher grade front end of open pits. So with that positive scoping study, I imagine, Grant, you've probably got some comments on what happens next with that assessment during the definitive feasibility.
Yeah, and a single pit or a large pit option at Cordillera is something that we've looked at before. What we included in the PFS announcement for Costa Fuego was our update of that. So we've got what we'd like to call our PFS case, and then the single pit option at Cordillera case, where we've looked. It's not done to the same accuracy level as our PFS, but it is encapsulating that larger pit shape that would be the primary means of extraction at Cordillera. And while that does unlock more material to be processed, what the economics at this stage is saying that it is not as superior financially. Previously, we had looked at a sort of interaction between the two financial measures on the projects, whereby at higher copper prices, the large open pit option came into its own and started to reduce superior economics. That hasn't really materialized at this PEA level, but as further to Christian's comments, it is at a PEA level. And so comparing it directly with a PFS to a PEA assessment of that large pit option is not really an apples for apples. And so you cannot draw too many conclusions from that comparison. As he said, the main conclusion you can draw is that it's positive, therefore it warrants further study. And if we were talking about a PFS to PFS comparison, then we might be able to make some more definitive conclusions as to its likelihood of being the way that we progress the project forward. There are some people who consider the block cave to be a large technical risk at the back end of the Costa Fuego project. There are other people who look at a large pit of that scale sitting in the topography at Cordillera as a risk of its own. It is not able to fully extract the block cave inventory at this stage. It takes 60 to 70% of that high grade core, but it's not able to get material that sits to the east because of the topography that surrounds that valley. It's running up against a real highland barrier, and that prevents the pit from migrating east and capturing all of the block cave. So with that, the significant waste capital that is required to be stripped off that pit also it is the primary driver of why the economics at a PA level aren't superior to the PFS economics using a block cave. We'll keep people updated as we progress that option further. But at this stage, it is something that is as apples to apples as we can get it without progressing to detailed waste design and really detailed scheduling. But the option that we've presented to the market is quite a useful revisit of that option and something that will proceed.
Perfect. Thank you. One more question. What are the remaining infrastructure pieces that need to be locked up by the company?
On infrastructure, we actually have another study going on. We don't talk about it a lot because we're not the majority partner or in the ownership of that, or even in the funding. Uniquely, again, these advantages of being down on the coast and centered in the middle of infrastructure that's being built. One of those key infrastructure assets is the existing Las Losas port. So this is a region with that much undeveloped copper, and no major mines other than CMP, our partners, iron ore mine, and this area doesn't have a bulk terminal for concentrate export out of a port. It doesn't have a water solution. All of these projects that are up in the Andes will be building their projects up in the Andes, and so suffering from that high capital intensity relationship, very big cost burdens to build infrastructure at 4,000 meters and above, bringing water pipelines up, building desalination plants of the scale that you've just seen, which is exactly what the opportunity is on that asset. One desalination plant, one pipeline servicing multiple mines, has huge capital savings for the combined region. But when we talk about what are the final infrastructure pieces here, the final infrastructure piece was already built. It's the port. It's Las Losas. Las Losas was built for multi-user usage by our partner CMP Cap next to their iron ore loading facilities and their nearby berth sitting in Huasco Bay, and next to the coal offloading for the big coal-fired power plant there that's being decommissioned in the next couple of years. So this entire port area is not really being utilised. There's one port, Las Losas, that sees less than 7% usage, and so is this asset that is sitting there not being used. We are engaged in funding 20% of a study along with our partner CMP Cap to look at a definitive feasibility to upgrade that port into a bulk concentrate terminal that at stage one can take 1.4 million tonnes per annum of concentrate movement. So we'll be paying out 20%, around $1 million US commitment on that, and that gives us a right of first refusal on that port for 80% of our product, first customer in line. So this is Hot Chili being at the forefront of key regional infrastructural enablers. And so an enabler for a large-scale port operation that will benefit all of these projects, creates good business for our partners, and gives us a home for our concentrates to truck it 60 kilometres straight down the hill, straight onto a port, and straight into Handymax vessels and into the Asian seaborne market if we so desire. So that is great on our port loading and handling costs, but that is a significant benefit to also all of our neighbours that probably don't want to truck their concentrates 300 kilometres to the north or south to the other existing port options that don't conveniently sit just below them. So that is really the last infrastructure piece, but it is a study and a timeline that is really in the control of our partner CMP Cap on their commercial side.
Perfect. Thank you. That wraps up the questions, Christian. So if you want to say some closing remarks before we wrap.
No, I don't think so. I think we've spoken enough, but no, thank you very much, Graham, for hosting this webinar. We look forward to having regular webinars with associated with each quarterly. So probably only around a month to go before our next webinar, and hopefully we'll be able to provide some great updates on the forthcoming news flow, really centered around continuing news around our board and our executive and our management team being strengthened and augmented, around our next set of drill results from La Verde, which is really, really exciting. We have 3 growth platforms here, 2 of them at pre-feasibility level, one being Costa Fuego, 15 years in the making, entering its last phase of investment. Another which has just been showcased on Huasco Water, adding another $1 billion potentially of NPV to our value stack. And then to be able to turn on a growth engine, a third pillar of value for the company at this time is very pleasing. So we probably believe that only one of those assets is being valued and significantly undervalued in the market. So really this is 2 assets for free with Hot Chili. We're one of the most de-risked, near-term, meaningful copper producers coming into the market, and we're now at a position that we can contemplate partnership discussions. So what I see on the horizon is continuing news flow, really centered around the growth of this 1 billion tonnes and this mine life at 20 years, and more importantly, how the company starts preparing as we move towards financing and really starting to employ some innovative catalysts on their own, which is centered around how we fund very low dilution to our shareholders, and in itself catalyzing value for our shareholders. So I'll finish there, and thank you very much, Ryan and Grant, for joining me for our North American investors, and thank you, Graham, for hosting the webinar.
Thank you all.
Thanks, Graham.